Welcome back. We'll now be reviewing personal liability umbrella insurance, Business 506, Cal Lutheran University. By the end of this lesson, you should be able to describe how an umbrella policy works and also understand the factors that impact your client's liability coverage need. So there's types of liability insurance. Common ones: automobile, general liability, it could be individual or commercial, and employer's liability, including workers' compensation. Insurer promises to defend the insured in lawsuits, and to indemnify or pay liability obligations of the insured in the event they're found liable. The personal umbrella policy is designed to provide liability coverage for catastrophic legal claims or judgments. Typically, the smallest you'll see is $1 million policy, and 10 million, a whole range, 1 to 10 million being the common range. They require the insured to carry certain underlying limits, specifying minimum amounts. So in plain English, you have to have your cars insured at a specific level, commonly $100,000 per person, $300,000 per accident, $100,000 property damage, or the other common number on auto insurance will be $250,000 per person, $500,000 per accident, $100,000 property damage. And the other part of the underlying limits is the homeowner's policy. Homeowners, condos, renters, whichever type of form you have to have the standard $100,000 minimum coverage. So next bullet point, it stacks on top of the underlying homeowners and auto policies. And if there's no underlying coverage, then the insured retains the self-retention amount. It basically becomes a deductible. Now, most insurers will not issue or keep in force a liability umbrella if the insured fails to maintain the two components of liability, homeowners and automobile. If by chance an auto policy lapsed out, wasn't paid, and all the other coverage is paid, and they had a big accident, well, in effect, they've created $100,000 or $250,000 deductible that they would be forced to retain before the umbrella policy would kick in. Some examples of stacking up. This shows various limits and how the umbrella is an extra $1 million on top of whatever the underlying limit is. So generally, covered perils, generally excluded in the umbrella policy, or in the underlying policy, extend over the umbrella policy as well. So there'll be alignment as far as what is and what is not covered. Now, certain types of liability are not typically covered in the underlying policies without any endorsement. So since the umbrella stacks, you have to have your agent or broker check on that. So for example, what the attorneys call advertising injury, libel and slander. On the homeowner's policy, it's an optional endorsement called personal injury endorsement. On the umbrella, it's automatically there. So again, check for alignment on those. And so a diagram of the perils covered on the umbrella policy versus the underlying policy, and if there is a deductible involved. So again, here's an example for you. A client carries a $2 million umbrella in addition to the $250,000 per person limit on the auto policy. Now, if a legal judgment of $1.7 million is obtained against him as a result of a covered accident, his auto policy is going to pay the underlying limit of $250,000, and the umbrella would pay the remaining $1.45 million. Needs analysis. How much do you need? The shorter answer is as much as you can afford. Generally, liability umbrella policies are cheap relative to the other policies. So do a needs analysis with the client. When you make a mistake and you kill somebody, or you damage a bunch of property, and the attorney sues you, the first thing the attorney's going to do is, in the discovery process, get a list of your assets and do an asset search. And liability only protects two things. It protects everything in your financial world today, all the assets, anything that could be sold in the event of a judgment. And the second thing is the income you're going to earn tomorrow, so garnishing wages. Now, in California, there is nothing prescribed by statute or case law as far as maximums of what can be taken from you. If you really mess up somebody and they have legal counsel, that attorney is going to be as aggressive as they can and get whatever they can from you. Your defense counsel, provided by the insurance company, is going to be defending you and trying to mitigate the damage there. So again, look at what do they have to protect, what investments retirement income, or excuse me, retirement savings, equity in the home, other investment accounts. Again, anything that can be sold in the event of a judgment. And again, I don't like the term rule of thumb, but look at their age today, because some people, rule of thumb, some people say 10 years or 20 years. I like the approach of look at their age today, look at their normal Social Security retirement age, subtract those numbers, get the difference, multiply that by their current income, and throw in a factor, maybe 3% a year for salary growth. Then you could discount that back net present value, get a lump sum, and go from there. So again, needs analysis. Know the client. Know their risk management goals and identify their exposures. Review their current risk management plan. Look at their current underlying liability coverage on all forms of insurance, and understand the form of business entity if applicable. So if they're self-employed, partnership, LLC, S Corp, C Corp, whichever it is. And develop recommendations based upon what you gather and what's available for them. So in reviewing their current liability plan, some important issues are the financial net worth, annual income, future earnings capacity, likelihood of being sued, financial and emotional capacity to self-insure, or in other words, to retain the exposure. So note, an umbrella policy is extremely cost-effective and is highly recommended. So in summary, we've had a chance to review umbrella liability policies and determine the client's liability coverage needs. Thanks for your time.